Hey everyone, my name's Andy. My channel is Finding Value. I've got Scotty back with me. He's from Sow and Reap Capital. He's got his Twitter handle, whatever you call that thing up there. He's got, more of a underscore and all that stuff in there. And I did see your Twitter followers have blown up, Scott. You're almost as much as me now. That's awesome. Good job.
Well, thanks to you, Andy.
And I guess a lot of people don't even know mine. Mine's at finding_finance if you want mine, if you want to join. And you can join my platinum membership from the website below if you want, on the companies that I like and prefer for this gigantic, I'll call it Herculean monstrosity. No, it's not a monstrosity. This huge commodity bull market that's coming. I'll just say that. I was going to try to make up some word, but I can't think of words right now. So what we're going to go over today is, how did we get to the spot that we're at today? How do we get there? How can we hold through this? How much research have we done? What was wasted research? Like, what did we look at that was a complete waste of time that you should definitely not look at? What should you be looking into? Who should you follow? Like, what kind of stuff, wrapped around that where you learned the most from? So Scott, how much have you been studying this? Like, it's not going to be exact, but how long have you been looking at the markets? What have you been looking at? And anything tied around your financial education that you've done?
Yeah, so when I first started investing in 2004, I'd say I spent at least an hour every day from 2004 till now. Probably without, I don't know, I don't think I've ever missed a day without looking at the markets, right? So I would say at least an hour every day from 2004 till now. And there were probably days like where I've spent way more than that. So I think I told you, like when I first started investing, it was a couple of years after I started investing that I came across Peter Schiff. I studied finance at uni, so I was fully into like looking at the balance sheets of all the companies in Australia, like doing fundamental analysis as I knew it, because the first book that I came across was The Intelligent Investor by Benjamin Graham. So I started fully getting into like balance sheets and looking at the financial statements and doing my analysis and all that. And so started off with that. I came across Peter Schiff and listened to his podcast, and I think I was like a paying member of his podcast at one stage, because I think he went on this like subscription type of program, from having free podcasts to subscription. So I was paying that for a while as well. I was listening to Mike Maloney, Harry Dent, all those guys for years and years. And then there was a phase where I went through reading through a lot of zero hedge articles as well. So I went through like all these different phases. I bought a bunch of books. I just read through a bunch of books as well. I'm a huge fan of Jesse Livermore. So definitely that was one of my favorite books, and read a bunch of trading books, technical analysis books. And when I started working, I was first a financial auditor. I started off as a lawyer, and then I transitioned into financial auditing. And so obviously I got to learn, it was like free education for me, because then I got to learn more deeply about how to write, how to read, financial statements for investing. So it was really good. It was really educational. My work provided me with huge benefits as well, just in terms of reading financial statements and reading behind the lines and through the lines, between the lines. And so, yeah, I spent so much time. And then I realized, like, one day, I think it's the same with you, like having followed like Peter Schiff for ages, I was like, hold on, like he's been saying the same thing for like since 2002, I think, when he first appeared or something like that. It's the same as if you listen to Peter Schiff's like videos in 2002 and listen to it now, it's like exactly the same message. We don't have a producing economy or a consumption based economy. We're gonna fail. When I say we, I'm in the US. So I was like, there's something wrong about this, because it's like the same message. The economy's changed, the price movements are changing. There's got to be something more behind this, where this is where I started looking at data. I was like all these people that I've been following have gotten it so wrong for so many years. What's the point, right? I'm going to do my own research and due diligence, and I'm just going to look through the data. So, just went through like drawing cause and effect relationships between all these different things, all these different data sets, and just started looking through all the random data sets until I found some things that were more relevant than others in driving the economy, in driving, certain price actions in certain markets. So yeah, just spent, I think I went through probably, similar path this year, but it's really just like, as I said, like just listening to a whole bunch of experts, different experts, like looking at CNBC, looking at whatever it might be, like, Goldman Sachs reports and JP Morgan's reports and all those things. And then realizing that they haven't got it right. And then moving on to Peter Schiff and Mike Maloney and Harry Denton, realizing that they haven't got it right. And I was like, what do I do from here? I was just look at data. So just started exploring and looking through a bunch of data just to see how it's performed and backtesting a lot, just continuously going back to the data and going, okay, well, I think this, sector must have done well during this time because this is what the data is telling you. Backtested a lot, and yeah, like I realized that only thing that's reliable is data. So now, like, all my focus is just on data. Like, and that's what I say. Like, show me the data. Like, if you're gonna make a bear case, show me a data that will convince me. Because don't show me like consumer sentiment, which hasn't been a reliable data to rely on, right? Show me something that's much more reliable, that's proven to be more reliable in the past. Show me the data that will convince me otherwise, because all the data that I'm aware of and all the data that I'm seeing right now, which I put a lot of importance on, is showing me that, we're going to have a massive commodity boom, regardless of what happens to the general equities. Because because I mean, you can talk about the housing crash, but housing is, like, I mean, as Andy says all the time, like, we've got low inventory, and unless there's a housing crash, right, I don't think the thesis, our commodities boom thesis, changes, because we've talked about it last time with the NASDAQ bubble, right? It's popping in 2000. All the commodities ran hard in 2000 while NASDAQ was falling. We didn't see a contagion. So just backtesting a whole bunch of data. And when someone points me to a data set, I'll go in and have a look at it straight away and to see whether I can backtest it again, back to the past. And if it doesn't work, if it hasn't worked in history, then there's no cause and effect relationship, or its effect isn't as great as people think it might be. So that's me.
Yeah, I'll share my journey. It wasn't pretty in the beginning. I was going through, and what I would do is I'd come home from work and I was obsessed. Like, I literally was trying to figure out how to make money in the stock market. So I would read through all of these analyst reports on Fidelity about the individual companies. And I'd read through them all, and I was like, okay, that's great, but I don't think I really learned anything. Like, that, in my opinion, that was a complete waste of time. Learning what anyone else thinks about the stock, complete waste of time. Like, just throw that in the garbage. Like if you're like, oh, well, this person comes out with a buy recommendation, total waste. Don't even look at it. It's complete garbage. So then I wasted a whole bunch of time reading that stuff. Then I started looking at other things like Mike Maloney and Peter Schiff and all the similar people that you were looking at. I was looking at other people, and over time, and it wasn't too much time. It was some time though, maybe 4 years, 3 years, 4 years, 5 years. I started figuring out, like, like, these guys, they're not right here. Like, there's something wrong. And you could, like, tell, like, they would say all these things and I'm like, this isn't aligning. No way. And then as time goes on, even more, like, I stopped. There was a period of time I didn't research as much on the markets as much. And then I came back and I looked at these guys again. I'm like, they're full of garbage. They're just saying the same stuff over and over. Like, something has obviously changed in the markets, and these guys are still parroting $5,000 gold, even though gold's going nowhere, for 2011 all the way till 2015, 16, 17. Like, in that time frame, it didn't really go up like they said it was. So then I said, these guys are full of, super high intensity training. They're full of that, if you take the acronym. And I started looking at a whole bunch of other things. I started looking at other people, other channels, other thing. And then you just find out that they're full of complete garbage. What they do is they give an opinion and it's based off of absolutely nothing. So an opinion, to have an opinion, is stupid. And that's my opinion. And on YouTube, if you watch most of these people, they have no idea what they're looking at. They have absolutely no idea. So what I did is I said, all right, I'm going to compete with these guys. I don't think they really know what they're doing. So I started looking at the data myself, and I'm an engineer background. So I am a numbers guy, literally. I went through all of the number stuff at a level that is probably more ridiculous than most people. So I could be considered partially a statistician. I could be considered kind of a quality control person, which is all statistic based stuff. And then I started, I went through dynamics, thermodynamics, statics, engineering statics, like all the engineering courses and mechanical stuff. And then you look at like balance sheets and you're like, really, this is it? This is stupid. Like anyone can do this. This is like first grade math. So then you start going through this, and I'm not saying I'm a great, I don't like looking through the balance sheets necessarily, but I look at them and I'm like, okay, this is their debt, this is their revenue, this is their income. Okay. And then you can see they're like hiding crap sometimes in their balance sheets, and their general administrative expenses are really high. You're like, this is garbage. What are they doing? They've got like 5 million in expenses for their health insurance, and there's like 5 employees. I'm like, yeah, I'm sure that's right. Yeah, you're not hiding any money there. But then you like go through all that, and in all honesty, like I don't, that part didn't really like draw me to these stocks. But then you start to figure out like, hey, the fundamental analysis doesn't work either, because this company looks great, but like it doesn't go anywhere forever. So what the heck is that? What is this leading me to? I can sit in this stock forever and it doesn't go anywhere. So then the next step was how can I tell that sectors are cheap or expensive? And how can I tell if I started asking all these questions? Really was what it came to. I said, what causes markets to move? What causes relative valuations to shift against each other? And how do you tell if something's expensive or cheap from a sector to a sector? So then I went into the ratio. And then I was trying to ask myself, what is a fact and what is an opinion? So people can have opinions and then they can have facts. The facts are ratios are facts, because you can tell relative asset valuations against each other based off of history. That's a fact, that's data. And you could draw conclusions from these facts. Everyone else, they'll give you like an opinion. They'll be like, well, just wait until these interest rates go up. And you're like, wait for what? Tell me the relationships. Tell me the data that's changing. Oh, you just wait. Wait for what? Is there historical precedence to this interest rate going up? Oh, interest rates are going to kill the housing market. How do you know that, Mr. God? I mean, do you know what's going to happen? And they don't know. They're full of crap. So what you need to look at, in my opinion, is you go to the data. What moves markets? If it's supply demand driven, it's inventories that you can get the raw data from. If you don't even need to know anything. You don't need to know how many buyers there are. You don't need to know how many sellers there are. Look at the inventory and see how that's interacting. And then look at the rate of drawdowns or the rate of increase. And you're saying, wow, they're really drawing this down. We have a problem, irrespective of demand destruction or supply constraints. Just look at the inventory. If it goes down, you're eating through it. If it's going up, that interaction. So that's one thing I found is a true way to measure and gauge everything. Inventory. And then, so you've got the ratios telling you where money's at, and then you can see how it's flowing. And then you can look at the inventories as another indicator to say, look, it's still continuing. Then you've got all these people who are like predicting the demand of stuff, right? Don't do that. Do not do that. That will make you look like a complete butthead. Okay, I'm trying to be like as honest as you can. Do not make predictions. What you need to do is you need to say, okay, we've got inventory, we've got ratios. Are the trends in place? Are they continuing to move up in a higher high, higher low? So we're identifying the change in trend and if the trend is in place. That is what I do. Then you look at inventories to make sure the trend is still continuing. Are your inventories drawing down? And it's okay to have a data point or two come back up, and it's okay to go up slowly because you're still in a bull market then if it goes up and your inventories are slightly creeping up. It's the fast rate of change that gets you. And you don't want to be like just adding into inventory rapidly. It's the boom in inventory that you don't want. And that is where I focus my efforts are the supply, demand, and inventory levels. Then the next thing I look at, because remember, I had to completely wash away all the garbage I learned before. Like it was complete garbage from all these so-called experts. And I'm not trying to be mean. Like they literally, they hindered my progress as an investor, honestly. So then the next thing I went in, there's a couple that are good. I'll call some out that are good later in the clip. Then the next thing is the denominator, which is the dollar. And the dollar, if you're pricing things in dollars or whatever currency you're pricing in, that matters a ton. So the supply demands the numerator, which is the top. That's like oil or copper or uranium. So your demand supply is the upper numerator. Your denominator is what you're pricing it in. So you can do two assets against each other, a numerator of oil and the denominator of gold, or vice versa, either way. And those are your two that you're comparing. But if you're pricing it in dollars, the dollar matters. So when I was looking at dollars, I went through the whole thing of asking, okay, what is inflation and deflation? So I had to answer that. Then I said, well, what causes inflation and what causes deflation? Then I answered that. That's the real estate market and the thesis that I have. And I went through what causes interest rates to go up, what prices assets. And those are all the denominator link down there. So you've got the numerator of what you're pricing, like the asset. And then you have the denominator that's wrapped around the dollar, the value of that thing that it's being priced in. What you want is the alignment of both of those. You need a declining dollar or inflation. And I'm not talking about the DXY, which is a relative indicator. I'm talking about the decline of the dollar. And then I'm talking about the numerator that has supply demand problems. So you can have a commodity boom and not have a supply demand problem. Does that make sense? Your denominator is forcing money to rotate differently. But this boom that we've got coming is both. It's both the denominator and the numerator, like the 1970s. What happened in the 1970s? We started that off with an oil crisis tied with what else? A housing boom, which is all liquidity coming into the system. That's where you get your big commodity bull markets. The 2000s wasn't a supply demand crunch. It was a liquidity crisis coming of money into the system. It was one of the two. So when you look at this, and I broke it all out, I was looking at all this stuff, we can tell that I'm going to call this a super commodity boom. A super commodity boom in a super duper cycle is coming, because we know that the demand and supply is messed up at the same time liquidity is coming into the system. It's brilliant, guys. It is. It's brilliant because it took me a long time to figure this out. It was not easy. I didn't sit down one day and said, oh yes, I just figured this all out. It took me time to figure out how things interconnect and how everything is interconnected. What you're going to find out is that absolutely everything across the entire spectrum is all nodes that are interconnected together. So if someone says we are going to have a crash in the technology sector and it's going to be a recession, what they don't understand is that that money has to come from that sector and feed something else. The ratio is in a zero-sum game. If there was no money coming into the system in a zero-sum game, if one asset goes up, another has to go down. The ratio, that means this sector is drawing money from this sector, and that's what causes that difference. And what we want is a multitude of things. We want money coming into the system. So we got money flowing into the system from real estate and all those loans. So they're literally like dumping, like if this was a big, huge water, they're like with a fire hose, they're like fire hosing water into the system. And then we want that money to get directed towards the things that are needed. And that's exactly the setup we have. We have the full alignment. So I know this is kind of going off, but we went into what'd you learn and from who, but this is all self-developed to a certain extent. At least in my mind, I had to develop this connection myself, and I used a whole bunch of different things to do it. I looked at what does the platinum to gold ratio mean, and then I looked at and said, okay, platinum is a larger inflation hedge than gold. So therefore, if you do the ratio, it tells me that when platinum's outperforming gold, or it looks like it's going to break, that we're in an inflationary period. So you can use ratios as data and indications to tell you the market conditions directly. And that took a long time to figure all those connections out. You know, if silver is outperforming gold, if platinum's outperforming gold, if platinum's outperforming XYZ, if oil is doing better than gold, what does that tell us? And then I went through and looked at all the ratios to figure out what those are all telling me. And then I had to do some of my own thinking, because I'll say the research isn't necessarily behind them. So I did my own kind of thinking and said, okay, if this is X, if this is Y, I looked at history and I said, okay, these move under these conditions, and I like tied it all together over time. And I know a lot of people maybe don't do that, but, and then I looked at the real estate market and tied it to the stock market. No one does that hardly, like hardly anyone. So then I saw these clear trends, and I was like, this is like cheating after this. This is like cheating. But then you're going to have all these people that are going to tell you you're wrong. That comes with becoming rich, I guess, or becoming very wealthy. They're going to, when you're like riding something, everybody's going to tell you you're wrong. They're going to be like, this is not right. This is wrong. It's a bubble. It's X, it's Y. And then you look at the data and you're just like laughing at them like, okay, yeah, sure. This is a bubble. That's like me running around a race course with a stopwatch that says I run 45 seconds. They run 47 seconds and they say, I'm faster than you. And you're like, no, you're not. It's right here. Like, here's the data. It's like, you're 2 seconds. You're not even close, bud. You're going to have to go back and go back to ride your, like, you know, bicycle and try to beat me there again. Bike racing, at least. But the thing that how can I say this? Because I know there's a lot of, you're going to have to think for yourself, unfortunately. And most of these people on YouTube are probably straying you away from where you need to be, unfortunately. And then, I mean, I'm not saying that I know everything. I'm not saying that, but when I listen to some of these YouTube clips, I know they are wrong. And I don't know if they're pushing this knowingly doing it, or if they're trying to do the fear factor. The emotions that people click on, they're twice as likely to click on something that hits them with a fear or a conditional need, like they are fearful of something, or they need something, like they need to know the information because it scares them. So people pander to that, and they get views, and then they get a positive feedback. So their positive feedback loop is feeding off of your fear. And I don't like that. I don't do that. I don't care about my necessary views. I care about being right. I care about people making money and trying to get people to stay the right course, because guess what? No one kept me on the right course. And I got so mad. I started this channel in August of 2020. In March and April of 2020, everyone was calling a crash. Graham Stevens, Meet Kevin, Reventure Consulting, all these guys, crash. There's a huge crash coming. I'm like, no, there is not. And then they would tell me this huge crash, and that the recession and all this other stuff. And I'm like, it's not a recession. It's a slowdown in the middle of an expansionary phase of real estate. Like, the demand will be there. The inflation's coming. Like, this is all perfect. And the housing market's underbuilt. Like, this, you can't get any more bullish than what we just went through. And then all the housing, they had the housing, and I'm sorry I'm talking so much here, but they had all the housing, and it started going up. We had no inventory, and everybody's like blaming it on the medical event, saying that is the reason for it. And I'm like, did you guys look at the inventory before it? It was declining the entire time. Like, BS, that's it. There's no way. And I don't know. Now I look at people and I just, like, I don't even want to watch them anymore. Like, I'm disgusted with it, because you get to the level where you start like figuring this stuff out, and it's like, I can't look at this. I can't even watch it. They're full of garbage. And maybe they just want to sell stuff. I don't know. I don't know why they do it. I get like irritated at it. So I started my own channel because I got so irritated that I got fed up, and I said, okay, whatever. And I'll debate these guys if you want. I mean, I don't know. They're going to talk about a bunch of stuff that doesn't mean anything. And then I'll just ask them, why do you think this means something? Like just ask them. And I don't know if they'll have an answer. Oh, there's 15 million homes in shadow inventory. Well, how do you buy shadow inventory? How come it's not on the market? How come it's not in inventory? Well, can people buy it? No. Then why are you counting it as inventory? Stupid. I don't know. That's just me. Like, I think it's retarded. I'm sorry for people who have a disability. I didn't mean that in that way, but it's doesn't make sense to me. It's the active inventory that can be purchased that I watch. And if inventory comes on, then I'll see it. It's not very hard, guys. This stuff doesn't move fast. You got to get your time frames right. You got to get the time frames right. So what else should we talk about, Scott? I mean, we've got, sorry for my little bit of a rant there, because I got kind of,
Yeah, that was good.
I got really mad when everybody calling the bubble in 2020. And I have people that weren't buying homes in 2020 because people said that. And I was like, no, buy now, get in. Like interest rates are low, prices are still low, get in it now. And I still think prices are going to go up. That's me. I don't think we have the housing inventory for it until we get rates maybe up around 8 or 9%. That's my take on it, to try to slow it down. I don't even know if it will slow it down. So
yeah, I think you definitely have to be careful who you listen to on YouTube or wherever it might be, because I remember when I first started working at a law firm, the first thing that the managing director of the law firm said to me was, you either to make money in law, you have to do one of two things. You either make them fearful or make them greedy. And so that's the marketing tactic that everyone uses. If you think about it, everyone's talking about a housing crash. They might actually not believe in it, but it's a selling tactic. That's what gets them the views. That's what gives them like YouTube revenue, or whatever subscription services that they're running. So just have to be careful. Like it's a fear mongering tactic that they use to drive sales. I think, yeah, you have to be careful.
So what? Who do you think is good? Who would you listen to? Like, who do you think is still a solid person? Because Peter Schiff isn't all around bad. He knows the economy. I think he explains it well. It's just his predictions and his timing, because he doesn't use real estate. He thinks that we're going to crash and all that. That's where I think he's wrong. But who do you think's still good? And who would you listen to besides myself?
I literally listen to no one.
No one? You've dropped everybody almost?
Yeah, I haven't watched anything. I mean, sometimes like something interesting, like an interesting topic pops up on like Palisade Gold Radio or something like that. Like sometimes around shipping or whatever. Like if I'm getting into an area that I'm not familiar with, like such as shipping, I'll probably would listen to a couple, but like just to kind of figure out which data points that I should be looking at rather than listening to their opinion, if that makes sense. So they might highlight like a bunch of data sets that they look at, and then I might go and pick up on that and go, okay, well, then I need to look at, the order book, for example, things like that. But I really don't, like, I've stopped listening to anyone like quite a long time ago now. So I watch some of your videos sometimes. I know your approach is like I do watch your videos because I think you bring out the data, right? Because it's not like your opinion. It's like, this is data that I'm seeing, like this is what I look at, and I'm like, yeah, that's cool, because that's what I want to see. Like, just look at data that's been proven over time. I don't want to be looking at consumer sentiment and all that. I know you backtest your data. I know you look at the data that's relevant. So that's probably, yeah, I would say I probably watch more of your videos than anyone else. Like, yeah, I don't watch anyone else, hardly ever.
Yeah, so there's a couple of really important things that I'm gonna tell everyone here that I've learned too. Peter Lynch says this one too. Just because the price of an asset goes up or down doesn't mean you're right or wrong. Does not mean you're right or wrong. And the pricing of assets does not mean or validate anything. So what you need to do is you need to dig down and see what's driving things. What are the leading indicators? What is driving X? What is driving Y? It's not the price. The price is like the dog is running and the tail is wagging. The price is the tail, like flinging all over the place. And you're thinking that the tail is making the decisions of where the dog is going. And it's like, no. And it doesn't validate that the tail moving left necessarily means that we're going left. Up doesn't mean that we're necessarily going to go up forever. Down doesn't mean we're necessarily going to go down. You need to know what drives things. So the stock market is a follower of everything. Interest rates impact it, inflation impacts it. All of these things impact the stock market. So the stock market isn't where you want to look. You want to look what is leading. So what is leading? What is leading is data like the housing starts, demographics. Like that is really where you should be focusing all of your efforts on, because if you understand that completely, you understand where this will go early. Like you're going to be 3 or 4 steps ahead. No one really tells you this. So the demographics impacts the housing, that relationship between the demographic and the housing sector. And this goes for any country if you want to look at inflation. And those who have declining populations will have declining real estate markets. Go look at Japan for an example. They have a declining real estate market because they have a declining demographic. And there was a large demographic that came through and the interest rate went up and went down after that demographic. It was like perfect. I use that as my secondary source to bounce my data off of. So I looked at the Japan's market and I said, okay, this is declining demographics. They should have a declining real estate market. And then I bounced it off that. Okay, we see it. And I'm like, what is this hump in house prices? Then I looked at the demographic. There was a hump in the demographic. I was like, oh man, this is all lining up. This is too easy. So then you can look at that and your rate of change, it's not the area under the curve that someone else said. It's your rate of change that matters, because what you want to look at is you want to look at the relationship of the housing that's out there and your rate of change of your demographic. Your rate of change is the amount of people coming in and hitting it like with a big force. So it's not, we're going from 1 buyer to 2 buyer to 3 buyer very slowly. We're going from 1 to 40 buyers in a heartbeat. It's like, boom, it shocks the market. And that shock is what causes the inflation rate to go up and down so much, because you have this large movement in the price of real estate, which then translates into new home builds and the higher price in the new home builds. So it's a combination of many things. And the rate of change, in my opinion, is what impacts things, not the area under the curve or the volume, which someone had said. So, and do not listen to opinions. Opinions, I literally, they really make me mad. They make me frustrated. They make me angry, because what people do is they'll throw out an opinion like it's a fact. They'll be like, millennials, they can't afford homes. They all have crappy jobs. And I'm like, why do you need to state that? One, you are completely wrong, because if you look at the data, we have no inventory of homes. So if we have no inventory of homes, who's buying them? Fictitious people? Millennials obviously have money to buy homes if we have no homes in inventory. That there, you can draw conclusions from the data that you have. You don't need people making these claims with no data backed by. So if millennials could not buy homes, then we would see a whole bunch of homes in inventory and the prices would be too high. The problem is we have no homes in inventory and the prices are not high enough. I mean, and I don't have to be a genius to figure that out. You just look at the inventory levels and you can make these conclusions. Another thing that people also do that I think is a wrong move is some of this stuff, when it gets on the fringe of being in a deficit and a surplus, when they see a surplus, it doesn't mean you just go and sell everything. And if you're real close, some of these markets are very hard to get accurate data on, especially really real time. And a lot of these companies guard everything they've got. So you don't know what exactly the percentages are of the things that go into their products. You don't know how much copper it uses. You don't know how much platinum. You don't know how much zinc. So most of these analysts are just guessing. So if you see a trend where something's coming down, don't be afraid if you have a year or two where it comes back up and then goes back down again, because this is not it's not a single variable equation here. You've got like 10 variables across. You've got or hundreds or millions of variables. You've got all these companies that have, proprietary setups where we don't know necessarily the setups of all these companies. No one wants to share it. They don't want to say, I use, 800 million ounces of silver a year in my iPhone. They can't come out and say that, because now everybody's gonna be like, oh my God, this is a huge shortage. You get panic in the market and then they can't get silver. So they have to hide everything. And when you see like platinum's going into a small surplus here, and the surplus we don't know what China's doing with palladium substituting platinum with palladium, or substituting palladium with platinum. We don't know that number. So they could come out and it could change in a heartbeat. So what you need to do is you got to position and just kind of be very patient, because we don't know the exact numbers real time. They kind of come out later. So be careful on what you're using for your data too. You kind of have to find something, lock onto it, think of what the future is going to be for this potential demand, and then just go with it. You got to roll the dice at some point. You got to say, I'm committed. I'm gonna do it. And that's another thing that I learned, when investing. And another thing about investing is, if you're going in and out, I'm sorry, it just doesn't work. Like, anyone who says, oh, well, why didn't you buy at the top here? Oh, why are you holding oil at this point? I'm like, because there's an energy crisis coming. Like you've got liquidity coming into the system, and we've got inventories drawing down, and OPEC is saying we've got major problems. And I'm like, why are you in anything but oil, or energy in general? Like to me, it comes very obvious to me. So it's not about playing the short-term movements. This is about positioning. And I'm going to be kind of honest here. If I lose on my commodity bet, this is just life in general. If I lose in my commodity bet and we don't have an inflationary period, well, then my earnings will be worth more. Like I'll be fine. There's no problem. Now, if I guess, let's just say, I'm not guessing, but if I position correctly and we get a large inflationary environment, I'm protected. I could lose on my earnings of what I make outside quite badly. So this is like a hedge. This is like insurance against something that's happening, which I think will probably happen with a high likelihood. So I kind of have to be there, because if it doesn't work out, all my money that I'm working and making money on is very valuable. If I'm right, then my investments go through the roof, and my money that I'm actually making goes way down in value, almost like I need to do it. That's another thing that I'm just kind of thinking of positioning in life. And another thing, if you've got cheap housing, this is what I thought back in the day. It's like, why not just buy a house, lock in your 30-year rate at very cheap, ultra cheap, all-time low interest rates. People are going to look back and be like, that was the best time to buy a house, period, bar none. It was the cheapest affordability that we've ever seen in anyone's life. Why would you not buy homes? Why would you not do that? And if you see a demographic that's coming that's larger, I mean, it's like, well, that's easy. So, I mean, like, all of this not just helps you become a better investor, it literally helps you position yourself for a better life. I mean, that right there could be huge. The difference between paying $1,000 a month and paying $2,000 a month for your house could be life-changing for some people. So learning this stuff inside and out, I mean, everybody, like, I'll talk about my website just because I have it. If you pay and you learn all this stuff, it doesn't just help you in investing, it'll help you in life. It'll help you be more patient. It'll help you raise kids. It will help you in all these different facets of your life. And maybe you'll learn more information and dig in, and maybe it helps you better become I know this is kind of like a far reach, helps you in interviewing people better, because you've researched all these different things. You become a lot more knowledgeable about a bunch of different areas. Kind of know how things work. And obviously I've got a degree in manufacturing, so I do all the, supply chain stuff. We did lots of calculations in industrial engineering with order points. How much should you order? When should you order? So now I know a little bit about supply chain. And then you look at all these other things about the life cycle of things going through manufacturing facilities. I mean, I don't know. I went through a lot of schooling. It's probably like a bachelor's and a master's put together in some of this, but very focused in that. And it helps you just in life and in general, because you kind of know what to expect. You kind of know how things work in the world. And then you can kind of tie it all together. And I did a whole bunch of projects outside too on a wide variety of things, like what's the difference between the octanes and the gasoline, a whole bunch of machinery type things and lubricants and frictions. And we did calculations on, if you have like a CNC machine and how it moves around corners, the step distances, and what we did calculations even to the point where we had your graphic or your CPU and the clocking speeds and how how little we could get making this curve. And it's ridiculous. I mean, I don't know, I can't remember it all today, but when I was doing it, it was pretty crazy. But what else you got, Scott? What else are you thinking the viewers should know about learning and some rules or some traits that you remember?
Well, getting back to natural gas, we did a video on this yesterday. This is why you don't trade in and out, right? This is why you just, learn the thesis, know the fundamentals, and you don't trade in and out, because now it looks like, I mean, although there was like a good chance of a rejection here and, coming down, potentially down to these levels and here, or even down to this level here, now it looks like we are breaking out in natural gas. We could be. If we can close this week above even this level here, like around the $9 level here, if we can close above here this week, that's mega bullish.
Why'd you choose that one? Is there a previous resistance up there?
Yeah, previous high.
Okay.
Like very small short-term interim high. So if I go back to the monthly chart, it's already broken out, I think.
Oh,
I mean, this could be the next level, but this could be the light resistance level, but it could very quickly run up to these levels, right? $14 here, or even up to here. So this is why you don't trade in and out, because you just don't know. There was a good probability that it would have bounced off the resistance level there, but it didn't. One day, that's exactly what we're going to see in uranium.
I'm not calling victory yet. Just let it go. We'll see what happens.
I know. I'm not either, but I'm just saying this is a possibility now that we're breaking out, right? And this is why, although this was a very likely area of a rejection, it coming down, and coming down to potentially these levels down here, like this is why you don't trade in and out. Like once you're in the commodity bull markets, you just have to sit tight. I mean, that's the biggest lesson, right? It's a difference between potentially a couple of baggers, like 2-3 baggers, versus a 50 bagger, like I've experienced back in the 2000s. And it's because of what Andy's talking about that I feel really confident about this commodity cycle. It's the inflationary pressure that's coming not just from the housing market, but also from all the money printing, and also from the expansion of all the loans out there. Like I think I shared this a little bit earlier, but this household debt to GDP ratio. If you look at this chart, oh, this is Australia. What's going on? Okay. So if you look at household debt to GDP ratio, it only goes back to the 2005. But if you look at this, it's been coming down. Like there's a heaps of room for loan expansion, which is inflationary. On top of that, you've got greater reserves set by the Federal Reserve. Because we are in a fractional reserve banking system, that additional reserve means the commercial banks can create even more loans using that as the foundation. So if you understand the money and the system and how it works and how much room we've got in commercial bank loans that we can go up by, just using household debt to GDP ratio, for example, like we can have a huge inflationary environment, huge. On top of that, we've got, as we talk about multiple times, we've got these demand and supply pictures across the commodities complex that we haven't seen before. Like in 2000s, I keep saying in 2000s, we didn't really have shortages of anything. Now we're coming up to a shortage in everything.
I know.
It's like, how do you line these facts up? Like, how do you line these data points up and go, we're going to have a huge deflationary pressure? Like, it just doesn't make sense. Like, I mean,
it's going to be horrible. I just look at that and I'm like, oh my God.
I know. And like delinquency rate, for example.
And that was copper that he was showing. That's across like 10, 15 different minerals.
It's across everything. Like uranium is crazy, right? Which is why I like uranium so much, because
well, it's an energy source too.
It's an energy crisis. It's an energy crisis. So that's your supply here. And then on top of that, I keep saying we've got like spot on top of this, all the financial players now, taking pounds off the ground. We've got potentially Japanese restart that's going to happen fairly soon as well. Like within the next 12 months, that will take another 10 to 15 million pounds per year off the
market.
Add 10 to 15 million, off the market. Yes, that's right.
Yeah,
And then like I'm just looking at data, and the way that I think about these things are a little bit different to Andy, because I focus more heavily on delinquency rates, but ultimately it's the same, right? When you look at the housing starts, if you look at all those things, it's pretty much the same. But I mean, there's no indication this is heading up. Like if you look at any delinquency rates right now, like I mean, someone talks about credit card loans as well, but I'm just saying, look at the delinquency rates on credit card loans. Like it's at historical lows. Like if you go back to the 1990s, like we haven't seen this level of delinquency rate on credit card loans.
It's almost like the Federal Reserve and the government did this on purpose. It's like they recapitalized everyone. They lowered the rates way down, and then they're like, everyone position. And then it was like Scott and I were like positioning. We're like, oh man, I got to get some precious metals. We got to get this. It's a reflation trade. It's this and this and this. And then they're like, the Federal Reserve will come out and they're like, art thou now be done. And then they just start like raising interest rates and like forcing the money over after all their banks had positioned. And now they're probably going to run the rates way up there. Get everyone to get all their bank buddies to make a whole bunch of loans against all these homes at very high interest rates. And then at the end of this, what I think is going to be a good bet here is to actually go into bonds when interest rates are high. And then when they lower the rates back down, you can make a killing with very low risk. So that's really surprising, because we've never talked about this, but that's exactly what I was thinking of doing. Yep, we've never discussed this, but I kept saying to my brother-in-law that that's the next trade after this is done. Yeah, you go to bonds, you wait for that crash in the housing market. I know if you get that crash, we have a high inventory level, big or small, you could get 30, 40, 50, 60% on your bonds, because as the interest rates go down in that type of environment, and you locked in very high interest rates on your bonds, you just absolutely murdered it. Like you killed it.
Yes.
Your returns.
And then
on a very low risk approach.
And then the next trade after that, wait a couple of years and then get back into general equities is my plan. So I'm sure you're thinking the same.
The tech game.
So we've never talked about this, but our plans are exactly the same, even before anything's happened. But so if you look at the delinquency rate on all loans, like we're down here. The market gives you warning well and truly before it happens. Like there's no need to predict what's coming. Like we've had, like from 2006, we've had it go up for two years before the market crash. So why would you try and pick the top here in anything? Like, I mean, why would you try and predict a liquidity event? Because I don't know. I don't think it's coming. I think we've got a huge fundamentals and market conditions that are ripe for commodities right now. And like as I keep saying, I'm in this for like 10x, 20x, 50x, 100x, 200x. I'm not in this to profit 50% here and there. Like that's not my thing. And it shouldn't be anyone's thing.
The technical charts for the individual companies are starting to look really, really good. So for me, I'm getting actually excited. Like I'm trying to figure out ways to put more money into it as much as I can when they're down. So, and I'll obviously on the Finding Value website, the Platinum members, I'm going to release a video. You can see that on the website on the companies that I really like. So, and what I'm personally adding into, and that may or may not fit with your strategy either. So I'll talk about a wide variety of companies. So do you have anything else to share, Scott? I mean, we went over a lot there in terms of current market conditions, and then also what we've learned over the years.
Yeah, no, not much. I think, as you said, I think some of the energy stocks are looking really good right now. I mean, it's just chart wise, they look beautiful. Lots of false breakdowns, and lots of them have now come above support, which means, the moves can be explosive. Yep. I am cautiously optimistic.
I am uncautiously optimistic. Yeah.
Yes.
Oh, well,
Yeah.
I'm getting too bullish.
This is probably. I'm getting way bullish right now. Like this is like the most bullish I've ever been.
Yep, me too.
Like
And when I see
everything's
that
just lining up so well. Everything's
see
just
nat-
lining up so well.
when I see natural gas break to the upside, remember I'm in a lot of natural gas. I'm getting pretty excited over this. And it may go back down. It may go back
Yep.
down. That's fine. But there's a good chance that it may not go back down and it rockets like a beast higher. So
yeah, and that's the
we'll see.
thing. Like short-term movements, you can't predict. So you have to just sit tight and just wait for it to go parabolic. Because one day, like I'm pretty confident. My confidence levels for like natural gas, like oil and uranium going parabolic at some stage within this bull market is really, really high. So like, what is the point? What is the point, worrying about the positions or, trying to trade in and out, trying to catch like 50% moves when I'm in this for like 50x.
Yep. So, I mean, that's all I've got, Scott. What about you? Anything else?
Yes, just wanted to share this. This is Acts 4:12. Salvation is found in no one else, for there is no other name under heaven given to mankind by which we must be saved. So no other name is referring to Jesus Christ. So Jesus is the only way in which we can go to heaven is what it's trying to say.
Okay, good. So that's thanks for coming on, Scott. I really appreciate getting you on here and having your opinion. And it's fun. Sometimes I get in my rants every once in a while because I just see stuff and people keep asking me questions about the same thing. So yeah, thanks for coming on, and thanks for the verse there, and I guess we'll see you next time.
See you, everyone.
See ya.